Compounding isn't addition, it's multiplication. And the difference between these two operations is the difference between dying middle class and building generational wealth. Most people treat their financial life like a simple math problem. They think if they save $1,000 this year and $1,000 next year, they'll have $2,000. That's addition, that's linear growth. And that's precisely why most people never escape financial mediocrity. The truly wealthy, the ones who build empires that last, they understand something fundamentally different. They understand exponential functions. They understand that 1 times 2 times 2 times 2 times 2 creates something entirely different than 1 plus 1 plus 1 plus 1. The human brain wasn't designed to grasp exponential growth. We evolved to think linearly because that's how our immediate environment worked. You hunt one animal, you feed your family for 1 day. You hunt 2 animals, you feed them for 2 days. Linear, predictable, safe. But wealth doesn't work that way. Wealth works through networks, through reinvestment, through systems that feed back into themselves. And if you don't understand this, if you're still thinking in linear terms, you're playing a game you cannot possibly win. Let me tell you about a turning point in my career. Not because it was glamorous, but because it taught me the single most important lesson about compounding. Early in my life, I was a mathematician. I worked with codes, with patterns, with systems that most people found incomprehensible. And I noticed something peculiar. The same mathematical principles that govern complex systems in nature, the same equations that predicted particle behavior, they also appeared in financial markets. But here's what fascinated me. The difference between a system that grows linearly and one that grows exponentially isn't just a matter of speed. It's a matter of fundamental structure. When I started Renaissance Technologies, I didn't start with the goal of making money. I started with the goal of finding patterns. And the pattern that emerged most clearly, the one that separated every successful long-term strategy from every failed one, was this. Consistency compounds, but only if you reinvest. Let me break this down mathematically, because mathematics doesn't lie and it doesn't care about your feelings. If you start with $100,000 and you add $10,000 every year, after 30 years you have $400,000. That's linear growth. It's predictable, it's safe, and it's a prison. But if you start with $100,000 and you grow it by 10% every year, after 30 years you have $1.7 million. Same annual percentage, completely different outcome. Why? Because you're not just growing the principal, you're growing the growth. You're earning returns on your returns. You're letting the system feed back into itself. And this is where most people make their first fatal mistake. They understand compounding intellectually, but they sabotage it practically. Every time they withdraw money, every time they spend the gains, every time they interrupt the compounding process, they're not just losing that money. They're losing all the future money that money would have generated. They're killing the exponential function and reverting back to linear growth. Here's a story that illustrates this perfectly, and it's one I've watched play out 1,000 times in different forms. Imagine 2 investors, both start with the same amount of capital, both achieve the same annual returns. Investor A withdraws 5% every year to fund their lifestyle. Investor B withdraws nothing for 20 years, letting everything compound, and only then begins taking distributions. After 30 years, Investor B has more than double what Investor A has. Same returns, same starting capital, completely different outcomes. The difference? Investor B understood that compounding isn't a feature you can turn on and off. It's a commitment. It's a system that demands patience and discipline. Every dollar you pull out is a dollar that can't work for you. Every interruption to the compounding process is an exponential cost you'll pay forever. And this brings me to the second critical principle that most people miss entirely. Compounding doesn't care about the size of your returns. It cares about the consistency and duration of your returns. Let me prove this to you mathematically. Would you rather have 50% returns for 5 years or 15% returns for 30 years? Most people, driven by greed and impatience, choose the 50%. They're wrong. 50% for 5 years turns 100,000 into 759,000. Impressive. But 15% for 30 years turns that same 100,000 into $66 million. Not 66,000, 66 million. This is why I built Renaissance on statistical models, not on hunches. This is why we focused on small, consistent edges, repeated millions of times, not on massive bets that could destroy us. The mathematics are unambiguous. Time is more powerful than rate of return, as long as the rate of return is positive and consistent. But here's the problem. Humans are psychologically incapable of patience. We want results now. We want to see dramatic changes immediately. We get bored with 15% when we hear stories about someone who made 500% on some cryptocurrency or meme stock. And so we abandon the exponential curve just when it's about to accelerate. I want you to understand something about exponential functions that isn't intuitive. An exponential curve spends most of its time looking like nothing is happening. If you plot compound growth on a graph, for the first half of the timeline, the line is nearly flat. It looks boring. It looks like you're wasting your time. This is where 99% of people quit. They look at their account after 5 years of compounding at 15% and they see it's doubled. They think that's all compounding does. It doubles your money over some period of time. They don't understand that they're living in the flat part of the exponential curve. They don't understand that if they just wait another 5 years, it won't just double again, it'll start accelerating. By year 20, they're not doubling anymore. They're tripling and quadrupling in shorter and shorter periods. By year 30, the growth in a single year exceeds everything they accumulated in the first decade. This is the power law of compounding. This is why every billionaire you've ever heard of, myself included, made the vast majority of their wealth in the final third of their career, not the first third. We didn't get smarter. We didn't work harder. We just stayed in the game long enough for compounding to shift from linear-looking growth to obviously exponential growth. But staying in the game requires something most people don't have, the ability to ignore short-term results and trust the mathematics. Let me tell you about the biggest psychological trap in compounding, because if you don't understand this, you'll sabotage yourself no matter how well you understand the math. Humans are loss averse. We feel the pain of losing money approximately 2.5 times more intensely than we feel the pleasure of gaining the same amount. This asymmetry in our emotional wiring makes us terrible at compounding. Here's why. Compounding requires you to take small, consistent risks over long periods of time. It requires you to stay invested when markets drop, when everyone around you is panicking, when every instinct in your body is screaming at you to sell and protect what you have left. But if you interrupt the compounding process during a downturn, you lock in your losses and you miss the recovery. And it's the recovery that makes compounding work. Let me give you a concrete example. The stock market, over any 30-year period in history, has never produced a negative return. Never. But over any 1-year period, it's negative about 1 in every 4 years. If you're checking your portfolio constantly, if you're reacting emotionally to short-term volatility, you'll see those down years and you'll panic. You'll sell low. You'll buy back in high. You'll destroy your compounding. But if you understand that volatility is the price you pay for long-term exponential growth, if you can train yourself to ignore the noise and trust the system, you'll capture returns that seem impossible to everyone else. This is why I built Renaissance around algorithms, not human traders. Algorithms don't panic. They don't have egos. They don't make emotional decisions. They follow the mathematics, even when the mathematics tell them to do something that feels wrong. And over time, that discipline compounds into extraordinary results Now let me address the most dangerous myth about compounding, the one that keeps more people poor than any other misconception. People think compounding only matters for retirement, that it's something you do when you're young so you can be comfortable when you're old. This is backwards. Compounding matters most right now. In every decision you make today, every skill you learn compounds. Every relationship you build compounds. Every dollar you invest in your own capabilities compounds. If you learn something today that makes you 1% more effective at your work, and you build on that every single day, in 5 years, you're not 5% better. You're exponentially better. You're playing in a different league. The same mathematics that govern financial compounding govern skill acquisition, network effects, and knowledge accumulation. But most people treat their lives linearly. They think if they work 40 hours this week and 40 hours next week, they'll get 80 hours of value. They won't. If you work 40 hours this week learning something new, and 40 hours next week building on what you learned, you're compounding your capabilities. The second week isn't just additive, it's multiplicative. You're building on a higher base. This is why the rich get richer and the poor stay poor. It's not a conspiracy. It's mathematics. People with resources can let those resources compound. People without resources have to consume everything they earn just to survive, which means they're stuck in linear growth. They can't access the exponential curve because they can't afford to wait for it to accelerate. This is the tragedy of poverty. And it's why I've spent significant time and money trying to improve mathematics education. If people understood compounding, really understood it at a deep mathematical level, they would make fundamentally different decisions about how they spend their time and money. Let me give you a framework for thinking about compounding that will change how you see every opportunity. Ask yourself this question about anything you're considering doing. Does this compound or does this consume? Does this investment of time or money or energy create future returns that I can reinvest, or does it simply disappear? A fancy dinner consumes, it's gone the moment you finish eating. Learning a new skill compounds. You'll use that skill thousands of times over your life, and each use makes you slightly better at it. A luxury car consumes. It depreciates the moment you drive it off the lot. An index fund compounds. It grows every year, and that growth generates more growth. This framework eliminates 90% of bad decisions immediately. If something consumes and doesn't compound, you should only do it if you have excess resources after you've maxed out your compounding opportunities. But most people do the opposite. They consume first and compound with whatever's left over. They buy the car, the clothes, the vacation, and then they try to invest the scraps, and then they wonder why they're not wealthy. The math is simple. If you're consuming 80% of your income and compounding 20%, you're running a 10-to-1 ratio against yourself. The compounding can't overcome the consumption. You're in linear growth mode with occasional exponential bumps. But if you flip that ratio, if you're compounding 80% and consuming 20%, the mathematics become unstoppable. In 10 years, you're financially independent. In 20 years, you're wealthy. In 30 years, you have generational resources, same income, different allocation, completely different life outcome. Now, let's talk about the single most important variable in compounding, the one that almost no one optimizes for. It's not your rate of return. It's not your starting capital. It's your compounding period, the length of time you can stay in the game without interruption. This is why I never took Renaissance public. Public companies face quarterly pressure. They have to show results every 90 days or investors revolt. That pressure forces short-term thinking. It interrupts long-term compounding strategies. By staying private, I could implement strategies that took years to prove out, strategies that looked like they were failing in the short term, but that I knew mathematically would succeed over time. And that patience, that ability to extend the compounding period, generated returns that public fund managers could never achieve. You need to think about your life the same way. What are you doing that shortens your compounding period? Are you changing strategies every time something doesn't work immediately? Are you job hopping for small salary increases instead of building deep expertise in one domain? Are you constantly restarting your investment approach based on whatever's hot right now? Every time you reset, you go back to the flat part of the exponential curve, you lose all the acceleration you'd built up. You start compounding from zero again. This is why people who chase trends never get wealthy. They're constantly resetting their compounding clock. They never stay in one game long enough for exponential growth to manifest. The optimal strategy is almost always to pick something with positive expected value, something where the mathematics are in your favor, and then never stop doing it. Let the decades stack up. Let the compounding run uninterrupted. Accept that you'll look stupid for years while everyone else is chasing whatever's exciting. And then watch what happens when your exponential curve finally enters its acceleration phase. Here's something that took me years to fully appreciate, and it's perhaps the most counterintuitive aspect of compounding. Small differences in rate of return create enormous differences in outcome, but only over long periods. Over 1 year, the difference between 8% and 12% returns is negligible. It's $4,000 on a $100,000 investment. Most people can't even feel that difference in their daily lives. But over 30 years, that 4 percentage point difference turns $100,000 into either 1 million or 3 million. It's the difference between a comfortable retirement and generational wealth. Yet, people obsess over optimizing things that don't matter and ignore the 4 percentage point differences that determine everything. They'll spend hours trying to save $20 on a purchase, but won't spend 20 hours learning about tax-advantaged investing structures. They'll chase a 5% higher salary at a new job, but won't invest in skills that could increase their earning power by 50% over a decade. They're optimizing the wrong variables because they're thinking linearly instead of exponentially. If you want to win the compounding game, you have to become obsessed with sustainable rate of improvement. Not massive wins, not home runs, just consistent, reliable, positive returns on everything you do. 4% better every year for 30 years is not 4% better. It's more than 3 times better. This is the mathematics that built Renaissance. We didn't try to hit home runs. We tried to find tiny edges, 1 or 0.2%, and then we repeated those edges millions of times with perfect discipline. The compounding did the rest. Let me address one final trap that destroys compounding for even sophisticated investors. It's the trap of comparison. When you're in the flat part of your exponential curve, everyone around you will look like they're doing better. They'll be making more money. They'll be buying bigger houses. They'll be posting their wins on social media. And you'll be sitting there with your boring, consistent, compounding strategy, watching your account grow by what seems like trivial amounts. This is the test. This is where discipline separates the wealthy from everyone else. If you abandon your compounding strategy to chase whatever's working for someone else right now, you reset your clock. You go back to zero. You'll lose all your accumulated progress. But if you can ignore the comparison, if you can trust the mathematics, even when it feels like you're being left behind, something remarkable happens. The people who look like they were winning, they eventually blow up. They were taking unsustainable risks to generate those flashy returns. They were in linear businesses disguised as exponential ones. They were confusing luck with skill, and when their luck runs out, they lose everything. Meanwhile, you're still there, still compounding, still building. And suddenly you look around and realize you've outlasted 99% of the people who started when you did. This is exactly what happened in the hedge fund industry. Thousands of funds launched with brilliant traders who generated massive returns for a few years. They raised billions. They bought yachts. They gave TED Talks. And then they disappeared. They blew up. They couldn't sustain their returns because they were based on market conditions or luck, not on mathematical edges. Renaissance is still here decades later because we never chased performance. We chased consistency. We let compounding do the work. So what does this mean for you practically right now? It means you need to audit your entire life through the lens of compounding. Look at where you're spending your time. Is it compounding or consuming? Look at where you're investing your money. Is it in assets that grow and throw off returns you can reinvest? Or is it in consumption disguised as investment? Look at your learning. Are you building deep expertise in domains that will matter for decades? Or are you skimming surfaces and accumulating trivia? Look at your relationships. Are you building a network of people who make you better, who you can help and who can help you over decades? Or are you surrounding yourself with people who just consume your time and energy? Every single area of your life either compounds or consumes. There's no neutral. And the cumulative effect of these choices, multiplied over decades, determines whether you die comfortable or whether you build something that outlasts you. Here's what I want you to do right now. I want you to pick one area of your life where you're currently consuming and convert it to compounding. Maybe you're spending money on things that depreciate. Redirect that money into index funds and never touch them. Maybe you're spending time on entertainment that just passes the hours. Redirect that time into learning a skill that will increase your income. Maybe you're staying in a job that's comfortable but not teaching you anything new. Move to a job that terrifies you but compounds your capabilities. The specific choice doesn't matter as much as the principle. Start compounding. Start now. Extend your time horizon. And never, ever interrupt the process. Now I need you to do something for me. If this explanation of compounding made sense to you, if you can see how it applies to your life, I want you to like this video. Not because I need the validation, but because the algorithm compounds too. Every like increases the reach of this content, which means more people learn these principles, which creates network effects that benefit everyone who understands them. And in the comments, I want you to write one sentence. Tell me the single biggest change you're going to make in your life based on what you now understand about compounding. Are you going to start investing? Are you going to stop withdrawing from your retirement account? Are you going to commit to learning one skill deeply instead of dabbling in 10? Write it down. Make it concrete. Because the act of writing it creates accountability. And accountability compounds into action. Let me leave you with this final thought. Compounding is the closest thing to magic that exists in mathematics. It turns time into money. It turns effort into expertise. It turns small advantages into insurmountable leads. But it only works if you understand it, trust it, and give it time to work. Most people never become wealthy because they never let compounding run long enough to enter its exponential phase. They quit in year 5 when they could have had everything by year 20. They interrupt the process to consume today what could have funded their entire future. They optimize for feeling good right now instead of setting up systems that compound into freedom. Don't be most people. Understand that you're not behind. You're just in the flat part of the curve. Keep compounding. Extend your time horizon. Ignore the noise. Trust the mathematics. And watch what happens when exponential growth finally reveals itself. That's how you really build wealth. That's how you really win. And that's how compounding actually works.